Today we're going to discuss investing in the stock market for lazy people. Yes, you heard it right. If you keep telling yourself, I'll start investing, but you always come up with new excuses, such as, I don't have enough time or I don't have enough money. It's time to put an end to it. Because the strategy we're going to share with you today will yield an average annual return of 8 to 11%. Just make sure you watch this video until the end because we will share with you another simple strategy that will yield even higher returns. So, let's dive right in. The strategy we're discussing today is perfect for those who prefer a hands-off approach to investing. It involves investing in the S&P 500 index every month, also known as dollar cost averaging, DCA. Have a look at the chart of the S&P 500 index in the last 100 years. As you can see, the S&P 500 has been on a constant rise in the long term. However, instead of investing in the S&P 500 index every month, most people try to time the market. The problem is that timing the market can be extremely challenging, even for experienced investors. And most people who attempt to do so end up failing, resulting in missed opportunities for market gains. JP Morgan research found that remaining fully invested in the market yields a higher return than trying to catch the bottom. Instead of trying to predict market highs and lows, DCA allows you to invest a fixed amount regularly, regardless of market conditions. This strategy helps mitigate the impact of short-term volatility and allows you to benefit from the long-term growth of the stock market. So, why is investing in the S&P 500 through DCA a great strategy for lazy investors? Let's look at some key benefits. Simplicity. Investing in the S&P 500 index is straightforward. It represents 500 of the largest and most reputable companies in the US, providing instant diversification across different sectors and industries. Reduced risk. By spreading your investments across the S&P 500 on a regular basis, you're reducing the impact of market fluctuations on your portfolio. This helps mitigate risk and smooths out the ups and downs of the market. Long-term growth. The stock market has historically shown positive long-term growth. By adopting a long-term mindset and consistently investing in the S&P 500, you position yourself to benefit from the overall upward trajectory of the market. Now, let's talk about how to implement this lazy investing strategy in the stock market. Set up an investment account. Open a brokerage account that allows you to invest in index funds or exchange-traded funds, ETFs, that track the S&P 500. Determine your investment amount. Decide how much you can comfortably invest every month. This amount should align with your financial goals and budget. Automate your investments. Set up automatic contributions to your investment account. This way, you won't have to worry about manually investing every month, and it becomes a hands-off process. Stay consistent. Stick to your investment plan and continue investing in the S&P 500 every month, regardless of short-term market fluctuations. Remember, this strategy is focused on long-term growth. And there you have it, investing in the stock market for lazy people using dollar cost averaging and focusing on the S&P 500. By adopting this approach, you can bypass the stress of timing the market and still achieve long-term growth. But before we finish, I promised you another lazy investment strategy called VCA, value cost averaging. It's quite similar to DCA. The difference lies in how the investment amount is adjusted based on market performance. With VCA, the investor sets a target growth rate or an amount of their asset base or portfolio each month and then adjusts the next month's contribution according to the relative gain or shortfall made on the original asset base. If the portfolio's value falls below the target, more money is invested. This strategy aims to maintain a consistent portfolio value over time, regardless of market conditions. Therefore, instead of investing a set amount each period, a VCA strategy makes investments based on the total size of the portfolio at each interval. By implementing VCA, you have the potential to increase your yield up to 12.5% on average per year. It's an effective way to optimize your returns while minimizing the effort and stress associated with timing the market. Now that you have learned about both DCA and VCA, you can choose the strategy that aligns best with your goals and preferences. Remember, investing doesn't have to be complicated or time-consuming. With the right approach, even beginners can achieve steady returns and grow their wealth over time. Thank you for joining us today as we explored the laziest ways to invest in the stock market. If you enjoyed this video, don't forget to like and subscribe to our channel for more insightful content. And feel free to leave any questions or comments down below.